Hi, everybody. Brenna Bockham, Collective Wealth Planning. Last month, we discussed creating your philanthropic philosophy, a personal, repeatable framework to guide charitable giving. This month, we're going to cover the qualified charitable distribution. This gifting strategy ensures that you apply your philanthropic philosophy in a tax-efficient way. So let's start by figuring out what is a qualified charitable distribution, or QCD. I'll refer to it as both throughout this video. A qualified charitable distribution, or QCD, is a charitable gifting technique that allows those of you who are over 70 and a half years old to donate funds directly from your qualified IRA, your individual retirement account, to a qualified charity without incurring taxes on the withdrawal. In very true tax talk, I just used the word qualified 3 times in the last sentence, so I feel compelled to spell out what these definitions mean. So qualified charitable distribution, again, you have to be over 70 and a half, and the donation must be made directly from the IRA to the charity. Qualified individual retirement account, so that is the account you are sending money from. It has to be a traditional IRA, inherited IRA, SEP IRA, or a simple IRA. And qualified charity. The charity must be a 501c3 organization. So why would we do this? What are the benefits of a qualified charitable distribution? So making a QCD allows you several advantages to optimize your charitable gifting strategy. One of the key benefits is that it allows you to fulfill your required minimum distribution obligations while supporting those charitable causes. So when you're making a QCD, the donated amount is not included in your taxable income, which provides kind of a dual advantage for reducing your tax liability. Your liability goes down and all of that money goes to the charity of choice, not just the after-tax portion. And we all know reducing our taxable income has ripple effects across various areas of tax obligations. So here's a couple of ways that could help you. One is taxation on Social Security benefits. So a lower taxable income could mean that less of your Social Security is subject to taxation. Itemized medical expenses. If you have a lower taxable income, you might be able to deduct a higher portion of your itemized medical expenses. Medicare Part D and B premiums. So what you pay for Medicare Part B and D premiums is based on your modified adjusted gross income. Excuse me. If your income is lower, you could reduce or eliminate the additional surcharges that you might be subject to otherwise. So this is a sneaky one because it's a cliff tax. It kicks in once you're just $1 over the limit. And it doesn't necessarily show up on your tax return, but can total thousands of dollars. So I'm going to talk about that more in just a minute. Your MAGI, we just talked about this. Lowering your MAGI can have an impact on various tax credits, and it might reduce your liability under the net investment income tax. And the standard deduction benefit. So if you do not have sufficient deductions to itemize, utilizing the QCD allows you to benefit from the standard deduction, which increased pretty significantly back in 2017 after the Tax Cuts and Jobs Act. And I'll show you an example of what that looks like in just a minute. So now we understand the benefits of a QCD. How do we make one? Let's talk about that. So for my client families, the QCD process often begins with creating a charitable gifting strategy, either at the start of the year, sometimes toward the end of the year. And this involves determining the amount and the frequency of gifts and identifying the philanthropic organizations that are going to receive them. So once we have that framework in mind, we can proceed with the following steps. So we want to first gather information about the charity that you want to support, their address, contact details. Sometimes custodians will want an EIN number for them. And then you're going to want to schedule a direct transfer of funds directly from the IRA custodian. And when I say custodian, I mean, where does your money live? Is it with Fidelity? Is it with Schwab? Is it with TD Ameritrade? Those are custodians. So that's who needs to send that money. If you're working with an advisor, that advisor obviously can facilitate that for you. So they're going to set that up directly from your custodian to the charitable organization. So this is an essential part to make sure that donation meets those requirements of the QCD. It can't be something they can't cut a check to you and then you write a check to the charity. It has to go direct. And then maintain paperwork. So you're going to receive a copy of the gift acknowledgement from the charity. And at the start of the year, you're going to receive a 1099-R from your custodian, and it will just show a distribution. It will not differentiate what part of that distribution went to a qualified charitable distribution and what part maybe you took out as a normal distribution. So it's going to be up to you to notify the IRS or your accountant, if you have an accountant, of the portion that was gifted through this QCD strategy in order to have that amount removed from your taxable income for the year. So for my client families, I send a tax letter to their CPAs at the end of every year, kind of summarizing some of the pieces that they need to know about, which include QCDs. So if you have an advisor, they may be willing to do the same thing. So a few other things to keep in mind when you are making a qualified charitable distribution. This strategy has a $100,000 per year per individual limit. And that is for, right now I'm recording this, we're in 2023. It's important to note that starting next year, 2024, that limit's going to increase with inflation, annual inflation adjustments. So it will go up. The charitable organization that receives the qualified charitable distribution cannot be a donor-advised fund. I'm sorry if that is disappointing. I know it is for many of my client families, but it is important to know that DAFs, donor-advised funds, cannot receive qualified charitable distributions. So oftentimes when I have clients who have a donor-advised fund, we're looking more toward appreciated assets or those kind of things to do some tax-efficient gifting there. And finally, the deadline to make a QCD is the end of the year, December 31st. So make sure that it is done. The transfer is complete to take advantage of it for the year. Now that you know all of that, you might be saying, okay, well, am I eligible? Can I make a qualified charitable distribution? So there are three main considerations. We've touched on each of them. The first is age. You have to be over 70.5 years old. And it's important to note that this may or may not be the age at which you started required minimum distributions. So there are two versions of the Secure Act that passed in the last few years that changed the required beginning date for many. And if you are looking for a summary of some of those latest changes, you can look to our blog. So I've got a post here about those changes from mid-January with some dates. So easy to find, okay, if I was born before this date, when do I need to start? If I'm born after this date, when do I need to start? So feel free to come in here and get that question answered. So age is the first one, over 70.5. IRA account type. So qualified charitable distributions, as we mentioned, can only be made from certain types of IRA accounts. So traditional IRAs, inherited IRAs, SEP IRAs, simple IRAs. QCDs cannot be made from Roth IRAs or from after-tax accounts. And then the third, which I've harped on a little bit, is the direct donation. So it has to be made directly from the IRA custodian to the charity as described. So hopefully that makes sense. And if you want a real simple way to know whether or not you can do a qualified charitable distribution, you can check out our flow chart on it. So you start here and just answer the questions along the way, and it will guide you through the decision-making process. So that's ideas. That's kind of high level, but I think always examples help us to understand a little bit better. So I want to explore two hypothetical scenarios with you. So the first is Sean Connery. So he is, of course, single. He's 75, and he earns $80,000 a year from his consulting work and another $30,000 from Social Security. So what I'm showing you right now is the back end of some of my tax planning software that I use. So on the left, we have Sean wanting to make a cash donation of $10,000 to his favorite charity, Doctors Without Borders, right? International charity, of course. And so on the left, here it is. He's taking that money out of his IRA, and then he's gifting it to Doctors Without Borders. as an itemized deduction. And here he's going to try the qualified charitable distribution to support that goal from his IRA. So in this case, if he does this, he can fulfill his required minimum distribution. So his RMD, say it was $7,500, he can gift, he's rounding up to $10,000. And then, like I said, he can gift up to $100,000 in any given year at this time if he wanted to. And what this does, it allows him to take advantage of the standard deduction, which I talked about a little bit earlier. So because his donation is still keeps him below the standard deduction for single filers, he's not really getting any tax benefit from that donation. He's getting the warm and fuzzy feeling, but he's not necessarily getting the tax benefit. So he gets the same amount of standard deduction either way. And he saves about $2,200 in taxes by doing this, and keeps him in the 22% bracket. So a number of different benefits here. Again, the timing on when you need to start RMDs has changed. So while in this example, Sean is 75, you can gift using the QCD as early as 70 and a half, whether or not you are subject to required minimum distributions. So something important to keep in mind. So here's just a quick summary of his kind of before and after distributions, his taxable income and the income tax itself and what is owed and the savings from one strategy to another. And this is really fun to do with client families if they have scenarios they want to run side by side and say, well, I have these pools in these various areas. What's the most beneficial way to do this? Well, let's plug it in and look at it, play it out before we actually go through and make those gifts. So the next example I have, Jordan and Brian Michael are 73. They both worked for the state and their income consists of some PERS income. They have Social Security dividends from their investment portfolios. So a little bit more complicated than Sean's case. And they earn more in pension and Social Security than they spend. So really their required minimum distribution is a tax burden that they're needing to do something with more than cash flow that they are living on. So they want to gift $50,000 to the YMCA where they both spent a lot of time as kids. And by doing this directly, that means they have $50,000 less than they would have had in taxable income, as we talked about. So again, brass tacks, they fulfill their RMD while they supported the charity they love. So kind of a win-win for both there. If I scroll down and see that, they do have a lower itemized deduction here, but not that much lower, right? Because standard deduction went up so high for single filers and they have a little bit of additional since they're over 65. There's a $19,000 difference here. And what this looks like, though, is a savings of almost $7,000 in taxes, just not having to claim that $50,000 on their return. And those sneaky Medicare surcharges I talked about, they stay under the limit. So, like I said, Medicare surcharges can be a real surprise because they don't show up anywhere obvious on your tax return. And they kick in when you're just $1 over the limitation. So $194,000 is the limit for married filing jointly when you start to pay this additional per month per person cost. So in this case and in this scenario, they're saving almost a little over $1,800 for the year by keeping their taxable income below that 194 threshold. So again, this is one of those kind of hidden pieces. And I encourage you, if you're thinking, I don't know much about Medicare surcharges, am I subject to them? What are the limits? What do they look like? I wrote a blog on it not that long ago, just about kind of summarizing this. This is really about if you want to try to appeal some of those surcharges, if you had a change in income over time. But it also gives you some high-level overview of what those surcharges are and where they kick in. So this might be a useful piece to look at. So anyway, all this to say, it behooved Jordan and Michael in this example to, again, gift using that qualified charitable distribution strategy. So in summary, qualified charitable distributions, they provide a simple and oftentimes more convenient way to support charities while potentially enjoying some higher annual tax deductions. But the benefits of using them versus taking out an RMD and making that charitable contribution, they're going to vary based on your individual circumstance. So every person's charitable gifting strategy is going to be considering a wide range of factors, including your long-term goals, your overall philanthropic philosophy, the legacy that you're hoping to build, where your assets are at, and what role they play in your plan. So while this video attempts to cover the essentials, the aspects and logistics of qualified charitable distributions, I hope I am not remiss in reminding you that you have to recognize all of the numerous considerations there are that are unique to you. So if you want a thought partner to delve a little bit deeper into your specific situation, run through some of these scenarios side by side and see what's possible and what's the most tax efficient way to give, I would love to have a conversation with you about it. Thanks for tuning in. Reach out anytime with any questions.